Bitcoin went up, gold went up, treasuries went up, and the stock market went up. 60-40 is broken. Owning bonds and equities is not going to work for the future. You must own a different 60-40. And I'm going to explain to you how to think about the ideological framework of the new 60-40, which is a radical portfolio theory.
I'm here today with Jeff Park, one of the smartest macro minds in the space. Very excited to have a conversation today. I'm sure we're going to touch on the current macro situation, on Bitcoin, on AI, of course, on your radical portfolio theory. So, Jeff, welcome to the channel.
Thank you. Thank you, Miles. Happy to be here.
For those who don't know you, do you want to give like a quick introduction on who you are and your background briefly?
Yeah, sure. So my name is Jeff. I started my career on Wall Street. I was a derivative trader at Morgan Stanley at the height of the financial crisis in 2008. So you can imagine that it was an incredible foray into the world of finance. But I learned a lot. And it's actually from those learnings that I discovered Bitcoin and really understood the value proposition of what a new financial order could look like that is built with a little bit more resilience and robustness that anchors towards individual self-sovereignty. And so I've been in the Bitcoin journey for a long time. You may know me most famously for having been the head of alpha strategies at Bitwise Asset Management, where I was able to build the alpha business and have enjoyed the incredible privilege of being with the team that launched the Bitcoin spot ETF. And so it's a new world in the US. Of course, there's so much going on always in tech. And I am just happy to be a part of this conversation, of course, with a bent towards crypto ethos, but also just forward looking about the importance of high agency and self-determination, which is why I think we're all here.
100%. Well said. I think, yeah, there's a lot to touch on. There's a lot happening. I was saying to you before we started recording, even if you're not a macro expert, you're kind of forced to be. Even if you're not an AI expert, you're kind of forced to be. So everyone is really having to exhibit, I think, high agency traits in such a fast moving environment. I mean, speaking of fast moving, let's start with the current macro situation. Obviously, there's been a lot of developments in the past 48 hours. So how are you specifically feeling about things? Of course, we had the ceasefire. There's been all sorts of reporting since then, as there always is. But yeah, how are you feeling now that I guess the dust is settling on the charts? Maybe not so much in real life.
Look, I think it's an uncertain time, and anyone would be lying if they knew how exactly this was going to play out with full confidence in the short term. But I think the long term is a lot clearer, which is in the long term, the outcome will probably be inflationary in many aspects of what the ramifications of a long-lasting war and conflict could be. I think that anchoring that with the general slowdown in the US economy, as we're seeing from credit conditions, is the counterbalance for which we have a hard time calibrating what is the Fed policy outcome that will come through. And of course, AI adds such an incredible element of uncertainty because of its fast pace towards how labor displacement could be taking hold and effect. And we're constantly seeing news flows of that kind. Disney, I think, also just came out yesterday announcing layoffs. And it came from the marketing department, presumably because you may not need as many bodies to do the marketing work that is now possible with the advent of some of this great tooling available. And so all of these things, I think, create a lot of uncertainty. But I think in the long run, what I do have a little bit more conviction on is that it's probably inflationary. And in an inflationary environment, you want to be asset owners, at least in the medium term. Now, I have a totally different view on like the perpetual long term as to what the generational liquidity trap could be. But in the moment of now, into the medium term, if you don't own assets, I think you're going to get left behind. And that's what you're seeing. When you saw the ceasefire announced, something incredible happened. Bitcoin went up, gold went up, treasuries went up, and the stock market went up. Talk about the lack of diversification of owning different assets that are meant to give you different degrees of freedom to allow building an uncorrelated portfolio. And what you just saw was every major asset class was correlated and moved in the exact same direction. You talked about traditional 60-40 when the general ethos of that alignment would have said bonds and equities should be uncorrelated because they're acting risk on and risk off, and owning both is what gives you a diversified exposure. I think what you just saw lifetime is all of them now move together. And that shows you that there's a certain level of hyper-financialization for which owning assets is probably going to be the most important thing. So yes, you can be a little bit cute about trying to time it. I do think it's a volatile time, and we are seeing dispersion within the equity market as well. But in the long run, I do believe owning assets is important to be able to participate in the inflationary growth that we are going to see. And Bitcoin, I do still believe, is probably going to be the fastest horse in that race.
Interesting. Why do you think Bitcoin is well positioned in the race?
I think Bitcoin is well positioned, one, from a valuation perspective, as a technical flow model would dictate today. What I mean by that is because Bitcoin's a commodity, Bitcoin doesn't have the same levers around having valuations anchored by multiples on price or earnings or growth rates that is determined by GDP. It doesn't have those types of handcuffs. Bitcoin is truly an asset that is driven by supply and demand. And if people like it, people buy it. It's kind of like gold in that sense. But the reason Bitcoin is superior to gold is because it's much more liquid, and it's much more financialized for a global population that can access the market in a way that gold cannot. So I know it's commonplace for investors to buy gold as the ETF and trade futures and all those things. But the reality is the physical ownership of gold is actually a market full of incredible friction, including the possibility of fraud. And that's why ultimately over time, I think people do understand the value proposition of Bitcoin and its ability to be a cross-border capital flow asset and the tremendous value that comes from it in a moment when geopolitics is increasing. And therefore, we are going to see some interesting things happen. For example, you may have seen earlier this week that Iran has announced that they would like to take their shipping tolls for the Strait of Hormuz in fees that is denominated in most likely Bitcoin. And that is super fascinating because on one hand, it shows you that the perfect money is the money that works for both America and Iran. As controversial as that might be, that is essentially what a medium of exchange should be. And Bitcoin has surfaced as a possible tooling for that maneuver. And I think that's actually the very long-term bull case for Bitcoin. Money that is good for America, that is also money that is good for Iran, is actually the global money that the world is going to want. And therefore, I do think Bitcoin, despite its kind of local peaks and local drawdowns, ultimately the terminal value is that those functions as a service is incredibly useful, and people will come around to seeing that to be a valuable thing.
I almost couldn't believe it when I saw that headline. What do you think of the cycle theory? Because people a lot of people reference it, and that's what everyone's talking about. It's supposed to be a bear market year. I've been vocal publicly, about how I don't think that the halving, especially with the diminishing effect of these, supply crunches has over time, every time it's halved, obviously. I've been vocal that I don't think it's really a thing, but a lot of people seem to stick to it. So just interested to hear your take on Bitcoin cycles and whether you also expected this to be a down year or whether you don't really pay attention to that at all.
Sure. I think it's important to pay attention to it, and we have to also be humble about understanding the ladders of causation. I think, we have a tendency to pattern recognize what's worked in the past can look similar in the future. But what you don't always know is what is the underlying variable that is concurrently happening. And one thing that I think is unique this cycle that was not relevant in the past cycles is the advent of AI. And I do think that there was a lot of capital rotation amongst the professional investor community, at least, that was onboarded through the ETFs that are looking at the opportunity cost of holding onto something like Bitcoin or actually investing in exponential growth. And that is ultimately a capital rotation where things could look a little bit more zero-sum game in the totality of capital flows. And I think that's been a tremendous pressure. I think there has been a lot of excitement for chasing growth in AI. And it has been the black hole, the vacuum of capital. All private equity, private credit has been focused on that expansion, especially in the context of it being a national security issue at some level. And so there are elements where that will probably set the tone for some time. And I think you saw that with the crashes in April, maybe in October as well, where the correlation between high-tech stocks and Bitcoin has been very high, higher than you would imagine it should or could have been based on the past. But going back to your original question, in the end, Bitcoin, again, is a commodity, and it will move based on the cost basis of investors and profit taking of those investors. that's essentially what I think a lot of these wave theories ultimately surmount to. And it's why it's been such a useful framework to assess macro peaks for commodities, because in the end, when you don't have a valuation anchor like stocks or securities that are determined by cash flow, what people are interested is understanding where buyers step in and where sellers step in. And the number one determinant of those behaviors is profits. So if you have a lot of people that made a lot of money, the probability of selling increases. And if you have a lot of people that have lost a lot of money, or there is no cost basis established for the floor that we're reaching, then people bid in and they start chipping away. So I do believe actually tracking the profit ratio is still probably one of the most important ways to assess Bitcoin breakouts. What's different though with the arrival of ETFs is that the holding duration has increased. I think in the past with crypto at large, the PvP action of retail trading was the dominant source of price action. And it usually involved some aspects of leverage in the perps market. And those things had some cyclical behavior around crypto wealth. What now has happened with the ETFs is there is new exogenous money that is coming in from the traditional investment community that have totally different capital costs and needs. And so their incentive to trade may not be its correlation to altcoins. It's going to be Bitcoin's correlation to gold and IGV and other things that they concern their portfolio construction with. So in arrival of those types of investors, I do think the 4-year cycle is probably going to look just very different because the holding period for those investors now going forward looks very different.
Well, we're in a society now where everyone is, I feel like, prompting Claude and ChatGPT for investment advice. But I'm pretty sure if they asked ChatGPT what to do with their money, it probably wouldn't tell them to follow this portfolio framework. But that's one of the reasons I was excited to get you on the show here, because I think you have a different way of thinking about portfolio construction. You call it the radical portfolio, but I'd love to dive into this, and genuinely curious about how you think about this and your framework around investing.
Yeah, well, first and foremost, I hope that Claude won't overtake the ingenuity of all of us to be able to produce interesting things. So I appreciate that. Though that time may come, so I'll have to enjoy it as I can for today. Look, the radical portfolio theory was an investment framework that I published about 2 years ago. And there were two reasons I did it. One was, as I was talking to institutional investors about Bitcoin while I was at Bitwise, one of the things that I learned is that if you walk into the room and you immediately start talking about Bitcoin to somebody who may be either apathetic or skeptical, you already lost the conversation because you basically introduced a topic that is uncomfortable for engagement. And so what I wanted to figure out was, how do I talk about things that are relatable in the investment community as to why they're taking this meeting in the first place, and then somehow draw them into Bitcoin as one of the conclusive assets that can be valuable in a journey and lead the horse to the water by the end. And so that was the practical motivation. And then the second was a spiritual one. And it's really because I believe that investing in Bitcoin is not just about buying the token. It's not just that endeavor that brings us all into this room here while we're all listening together in this webinar. It's because Bitcoin is a mindset, and that mindset has so much applications beyond just crypto that I felt it was important to share how to use those skills to bring self-determination to your own portfolio, to diversify in ways that the schools or the pundits or CNBC is not teaching you. And ultimately realize that 60-40 is broken. Owning bonds and equities is not going to work for the future. You must own a different 60-40. And I'm going to explain to you how to think about the ideological framework of the new 60-40, which is the radical portfolio theory.
All right, let's get into it.
Yeah. So the foundation of the radical portfolio theory is pretty simple, which is, as I alluded to, the growth model that we've been taught in economic 101 is largely failing. And why is it failing? It's because the economic principles that were taught in portfolio theory is fundamentally based off of the notion of the risk-free rate. Everything you know about modern finance goes back to the letter R, footnote F. And the risk-free rate sets the price for every asset that you own across the world because it is deemed that US creditworthiness is ultimately the most sacred thing that can be untouched by the dollar hegemony. What we're seeing now, and I think we've been seeing it for a while, is that we have to be open-minded to the risk-free rate being challenged. And in a world where the risk-free rate is challenged, everything you've known about 60/40 is not going to be the way that it should be. And so understanding why the risk-free rate is challenged is important, and there's multiple fronts for it. One, of course, is geopolitics, but the other part really is that all Bitcoin investors would know is that US creditworthiness is on a decline. And it's on a decline because there is a serious fiscal deficit issue that is being unaddressed while we have a pretty uneven cost structure for society at large that is allowing true growth. And that's the third point I want to land on. Growth is something that we're taught as a measure of GDP. And GDP is measured by combining four attributes. It's consumption, it's investment, it's government expenditures, and it's net exports. But what you've seen is that the complexion of GDP has been changing for a long time now, where it's not driven as much by the C's and the I's, but really by the G. And so you have to ask yourself, if the government is spending money and creating growth, well, is that growth in the way that private investors and private markets are trying to understand their cost of capital? And I think this is the million, billion, trillion dollar question, and why the growth model is largely failing the world everywhere, because we are not seeing real productive gains. The growth is coming from credit. And when growth is coming from credit, the financial system is going to look really, really different. So with that mindset, we have to find other assets to own. And to find other assets to own, you need to have a new manifesto and a mental reset about how to underwrite new asset classes. And one of the things that I talk about is basically how the world is centralizing to a level where global liquidity is becoming the biggest driver of asset price setting, where cross-border flows is overwhelming every sense of price discovery and direction. Think about the fact that we are about to witness some of the largest IPOs on earth: SpaceX, OpenAI, Anthropic, whichever it may be. And these are going to be IPOs that are going to basically overwhelm the current publicly traded market. If SpaceX finds itself into NASDAQ, into the index as it's trying to plan, it'll be singularly the biggest capital rotation event that the US capital markets has ever experienced. And it is happening in a way that is totally detached from the way public capital formation strategies would have happened with what a traditional IPO could have or should have looked like. And so understanding this is, I think, so important to then understand what are other things that is not part of this system that can still diversify my portfolio. And that's where I talk about how to think about, like, what are the 40%? What is the true, what I call like resistance assets that you must own in your portfolio to seek true diversification away from the common underpinning anchor of what I call the giant global liquidity trade that everything is correlated in.
Going back to the theory,
Yes.
So the traditional split is 60% equities, 40% in bonds for safety. You're suggesting that we should reframe it to 60% compliance, 40% resistance.
Yes. So what I'm saying is, if you own 60 equity and 40 bonds, you're actually owning 100 of something. And that 100 of something is global carry. You're long global carry, which is why everything is moving together. It's why stocks and bonds both went up upon the Iran ceasefire, and you're not diversified at all. And if you look at the SPX and bond 20, 30-year bond correlation over the last 5 years, it looks incredibly correlated. And I should actually share it with you after this, and you can share it with your community. And it'll wake you up. It'll just make you realize, oh, it's not 60/40, it's 100 of one thing. And so then that 60 I define as centralized assets. These are kind of assets that are participating in the compliant rails of the global carry system with maximalist state um, uh, stewardship. So these are equities, these are bonds. I would include private equity, private credit. All of these commoditized institutional investment asset classes are in that bucket. So then what's the 40? Like, what's the interesting 40? The
The
interesting,
fun stuff.
the fun stuff, the exotic stuff, the weird stuff is what I call resistance assets, and they have three characteristics. One, it's decentralized. These assets are actually not owned by the institutions I just mentioned. They are owned by a very different cohort of people. And ideally, it is owned by the broadest swath of the global population. Two, it values privacy. These are assets that, for reasons that I think humans believe privacy is important, is not necessarily things that are reported out into a common ledger that can then be assumed by a transfer agent. In other words, it's non-custodial in nature. These are things that you may actually just have in your home, and therefore doesn't participate in the financial system. And the third characteristic is minimalist state intervention, which is related to some aspects of what I just talked about, but it really is connoting to the point that these are not sovereign wealth funds that are chasing ownership of these assets, for which the price discovery mechanism is detached from these other 60% compliance assets. And then I talked a little bit about the form factor as to how you should think about it. So, for example, if you own gold and you own it like as a GLD ETF, I might say that is a resistance asset, but it's also slightly in the compliance asset because it's the form factor that is actually one in which you can get censored, right? When you own GLD ETF, you don't actually own gold. You own a bunch of IOUs that tell you that you own a piece of gold. When you have gold bars and you lock it up in your safe box, well, that's real gold. I mean, that's non-custodial, that's private, that's totally decentralized. And so it's a little bit of that mindset we have to borrow about owning things in a different way that lets you participate in a different economic stream. And then I talk about a bunch of different assets. I think at one point I listed 25 different asset classes you can look into peering for that frontier. And it's ranging anywhere from things that your community may already know, like Pokemon cards. As ridiculous as that sounds, there's value in things that people own across a swath of population that is deemed to be valuable, is deemed to be scarce, is deemed to actually be non-custodial in its interest. And then you have things like watches and jewelry that are collected. It may be art. It may be this category of assets that billionaires already know are valuable, which is why they invest very differently than what financial advisors may tell you. And the list is very long, but it's interesting and one that I continue to explore with a lot of earnestness to showcase why they're important. And what you see is that these resistance assets actually have outperformed the S&P 500 in many, many ways over a long period of time.
Do you have an index for that? That would be interesting. Obviously, it would depend how you weight it.
Yeah, I love that question. I've been wanting, Miles, for years to create that index. I've been actually scounging the earth to figure out how to do it. But the reality is, because of the virtue of it,
and it makes it the 60.
it's very, very hard. Yes.
Yeah.
But you may have seen that people have tried to actually show a Pokemon card index and its performance by compiling some of it. I think some literature is out there. Another popular one that people can pull is, women love to collect the Hermes Birkin bag, which has long been told has outperformed the S&P 500 for over 30 years due to inflation. And there's tons of data around those types of kind of material goods. But it's also hard to find it on some of the more esoteric assets because those tend to also not be totally non-fungible. Like each artwork is so unique that how you define the index of what you consider to be high art may just not be the same consideration you would put. And so every person might have to customize their own risk preference slightly differently. That makes it slightly challenging. But it's a great question, and it's one that I would love to quantify and something I'm constantly working towards. So if you have any suggestions or if anyone listening here has some interesting data that they want to feed into my machine to kind of quantify some of this, please ping them my way.
AI, I think, can help you run some models and maybe figure it out. I'm just reflecting on this, and I'd actually be interested on AI after this to take my portfolio and put in your framework and then see where I'm actually at. But I'm just thinking, out of my head, like I reckon I'm skewing much more towards 60% compliance, probably higher, maybe 80, 90%, because I even think about things like, oh, real estate. Well, technically that's compliance. Oh, Bitcoin. Yeah, but not all of it's on a ledger. Some of it's in ETF. So that's compliance, kind of. Um, I don't know. Actually, where do you sit on that? Where do you sit on the ETFs? Is that compliance or is that decentralized?
I think it moves into a compliance wrapper of an otherwise decentralized asset. And so, and that kind of generational kind of mix that is happening right now is what is unsettling about Bitcoin. I think it's a lot of the discontent people are seeing about crypto at large, where they're saying crypto's been captured. And it's because it is moving towards these compliant rails, which, may require some graduation and maturity to bring new investors. But then I think what you want to do is still find the case for it to be uncorrelated. One thing I'll also bring up that I forgot to mention, beyond these three parameters that we mentioned, the most important thing to understand about global finance today is that all financial assets are manipulation at some level. When the government tells you that bonds are worth something because you're borrowing for 30 years, what they're doing is they're manipulating your time preference. And they're basically saying that you have 30 years of a bet to make, and we are playing with the yield curve. And what you realize is most of finance, most of the modern economy, most of what central banks are doing is time manipulation. And it is time manipulation that then begets liquidity manipulation. And the thing that is interesting about resistance assets is that they are not time manipulation. Resistance assets are valuable because they're energy manipulation, because time is liquid energy. And once you think about the value of time and how to deconstruct time, you get to understand that energy is really valuable. And there's many ways to capitalize on energy. Bitcoin's one of them, as we all know, with their proof of work. But there's many ways to think about capitalizing energy that then becomes valuable. Why is a great work of art valuable? Because it took the energy and ingenuity of some human capital to create something that cannot be printed out of thin air. It cannot be printed by the printing press. And it takes energy. And so one of the things I also talk about is the rise of prediction markets. Prediction markets is within every definition of what I call resistance assets. And it is because the effort it takes for you to be able to be a positive EV investor in a prediction market is entirely driven by your own human capital input and the labor you put behind it. Meaning, if you have an edge in some information, it is because that edge was something you were able to provide on your own through research or some level of cleverness that isn't going to come from the manipulation of the technical fabric of liquidity manipulation, because events expire, right? Every bet on Polymarket, on Myriad, on Kalshi, they expire. And guess what doesn't expire? The constant rolling of bonds, the constant rolling of equities from the old people to the next generation, to the next children with the Trump accounts. And the game of information markets is that it's a precise bet you're making, and it's going to expire, and you're putting your energy towards making that into a positive EV endeavor. And so I believe prediction markets is also one of the next big things that a lot of people are going to realize how important it is to think about in financial portfolio construction. And it will be the new underpinning and a pillar of modern financial theory. And it's going to play a great role for diversification.
It's also a new source of truth, I feel, for a lot of people. Like even throughout this, these events, you see so many different headlines. So being able to refer to a poly market and see what the market actually thinks was quite interesting, because you'd see a headline and then the odds wouldn't change.
Yeah, that's right. In the radical portfolio theory, in section 2, I talk about a manifesto that I wrote, and it has 5 bullets, but it really is to help you reset your mind towards what it means to be a radical investor. And one of the first lines I start with is this idea that we don't really know what truth is in absolution with things like social sciences. Like there can be notions of truth in chemistry and physics, but truth in the social world and in economics is an abstract existence. And so what we believe is that the opposite of misinformation is actually not truth. which is a common thing people get wrong. The opposite of misinformation is state-controlled information. That's the spectrum that we're dealing with when it comes to defining what truth can be. And what Polymarket and Kalshi and Myriad and all these prediction markets do is that they're trying to make the wisdom of the crowd come to help information discovery in a much more playing field by economically incentivizing the outcome, which I think is an ingenious invention. And it is one that timeless research has shown is more powerful than polling, and one that I think does add tremendous value to society.
So if people want to get exposure to this value creation, what can they do? Obviously, not a lot of them have liquid tokens or equities.
Yeah. One is, I think, you got to understand statistics. So the great thing about betting in prediction markets or any of these closed-ended markets that have expiration is that you're always thinking about bets and ratios of outcome and a risk-reward concept. And that means you really have to understand probability, and you have to understand the ways to think through Bayesian probabilities. And you actually do need some root in foundational math. So that's the first thing. I would urge everybody to brush up on their statistics. And that's good for not just your own finance, but it's good for your mental model to reassess the world in a more probabilistic lens rather than a deterministic lens, which is going to help you determine that nothing in life is ever black and white, but somewhere in between. The other thing is you should find expertise in a market that you believe you are better than everybody else. And look, everyone can add value in some capacity of an information for which they believe that they might know better than another. And this is how you arrive at more precise investment outcomes than buying a stock. So for example, I think one of the great things that will come with prediction markets is that it's going to be able to compartmentalize investment bets into primitives that are far less dirty from the basis risk that you're trying to invest in. So let's say you think Apple is going to have a blowout revenue, and you know that you think you've modeled it out, and you think revenue is going to exceed target. The problem is buying Apple stock alone is not going to give you that exposure, because let's say it did, but let's say some other things went wrong endogenously by Apple or exogenously by other investors' behavior. The stock actually doesn't behave the way you expect it to. So you actually were right, but the implementation was wrong. That is an incredible disservice. So what I think is really powerful here is if you reduce the primitive to actionable precision, then you are more empowered to actually bet with conviction on the research and knowledge that you have been able to ascertain through work and your own ingenuity. And that is incredibly valuable. So a lot of times I hear this where people say, Jeff, you talk about prediction markets as if it's not gambling. And I hear some of this because people conflate prediction markets with other things like sports betting, or maybe totally random event betting type stuff where is Trump going to say XYZ words on his next State of the Union? But that's not the TAM of prediction markets. And what I say to people is that the difference between investing and gambling, it's not anything beyond the fact that it's determined by whether you think one is positive EV and one is negative EV, right? It's actually not whether anything has to do with the system itself being deterministic or stochastic. And what that tells you is that whether you think prediction markets is investing or gambling is entirely determined by the player and not the game. That, I think, is the important takeaway that people should have about what prediction markets mean, and whether you can channel an ability to generate a positive EV outcome in a way that sometimes investing in stocks might not let you either, no matter how well your research may be.
Well, thank you very much for joining, Jeff. It was a great conversation.
Yes.
Not only wise on the macro side, but also I think you've got some good philosophical views as well, which comes across obviously more on video than in written content. So yeah, it was good fun, and hopefully we'll have you back sometime.
Would love to. Yeah, keep the great work, Miles. I'm always learning from you too. So happy and honored to be here.